My name is Lynn Gillette. I'm the president of the Silicon Valley chapter and welcome you to the second half of our Saturday, October 8th program. Our speaker is Rob Bernstein, and his topic is managing volatility and uncertainty. How did your plan work? ? A very good question, particularly at the point we are right now in a bear market. Rob is the president of the RGB Capital Group LLC, where he manages personal and client portfolios driven by the economic decline during the 2008 bear market. Mr. Bernstein started RGB Capital in August 2009 to help others avoid the life-altering declines. Prior to starting RGB Capital Group, he was a consultant with Deloitte Touche for over 11 years and served 4 years as Chief Information Officer at Newland Communities, a real estate development company. Bernstein has a BA in quantitative economics and decision sciences from the University of California, San Diego, and an MBA in finance and accounting from William E. Simon School of Business in the University of Rochester in Rochester, New York. I think your topic and subject matter fit perfectly with the time we're in right now in the market. So Rob, you had the forum, and we're looking forward to your comments.
Great, thank you, Lynn. Want to thank you and the rest of the chapter board for having me back here today. The last time I spoke to your chapter was October of 2019. I actually did an in-person presentation just a few months before really the world as we knew it really changed in quite a dramatic way. So I think this is a great time to take a look at how all those events that have happened since our October 2019 meeting have impacted the financial markets and how they've impacted the strategy that I shared with all of you back in October of 2019. Hard for me to take a poll. I'd really love to be curious to see how many people attended that session, but don't worry if you didn't see it. I will make sure that we review those concepts. But at that time, I shared a quote from Benjamin Franklin, and the quote is, as you can see on your screen here, if you fail to plan, you are planning to fail. So I asked all of you at that time if you had a plan to deal with the volatility and the uncertainty that was likely to be present in the future. And if you didn't, I was certainly trying to encourage everyone to adopt a plan that would take care of the volatility and create portfolios that were consistent with your tolerance for risk. And one way, what I did at that time was I shared with you what my plan was, how I deal with the uncertainty in the stock market. And I think today is a great opportunity to check in to see how we did. It's probably a good time for each of you to maybe do a self-evaluation of your own portfolio and your own investing and assess how your plan worked. If it worked for you, that's fantastic. If not, it's a great time to make adjustments and changes to make sure that you're generating or creating portfolios that match your tolerance for risk. So with that, let me put up this slide. So this is a slide of the S&P 500. I've marked the October 19th date here, which is the day that I presented to the Silicon Valley chapter a few years ago. And let's just I'd like to do a little recap, because at that time we had already been through the tech bubble, which saw a 50% plus decline in the market. The S&P rallied 100%, regained all those declines, those losses, only to fall back down another 50+% during the great financial crisis. And then we entered this period of what looks like some stability, but it wasn't without bumps along the way. We had the debt ceiling debate that created I believe this was about a 15% decline in the S&P 500. We have what I call the stealth bear market between 2014 and 2016. This was really a time where the S&P, I think, was only down 14-15%. but many of the other indices were down in what they consider a technical bear market, 20% or more decline. Because the S&P didn't hit that mark, didn't get a lot of attention, but it was certainly a volatile period in the market. We then incurred the Fed fumble. This is when Fed Chairman Powell was raising interest rates, and the market certainly disagreed with his approach, that it was too soon. The market couldn't withstand the rates that and the monetary policy that he was proposing, and sold off pretty heavily. The market went down, I think, 18–19% during that time period. And then it rallied and was in a relatively stable ascent when I presented last time. And as I said before, I encouraged everyone to develop a plan to deal with the uncertainty and volatility that was going to be in the future. Not that I had any idea that we were going to face a global pandemic, followed by a period of excessive government stimulus that really took the stock market to new highs, and then to be faced with the current bear market, which has been driven mostly by high inflation and aggressive monetary policy. So with all this, I thought I would start off with to kind of do a self-assessment of my own plan. How did my own investing work during this time period? But before we go there, I want to remind you of two slides, two concepts that I shared with you back in 2019. The first one, rule number one, according to Warren Buffett, is don't lose money. I like to alter that just slightly to say don't lose a lot of money. As investors, we have to expose ourselves to risk. We will always experience losses of some sort. The magnitude of those losses we want to minimize. And this is the reason why. On this chart, in the area, red shaded area, depicts the loss, the potential loss that you could incur in your portfolio, anywhere from 0 on this chart down to 90%. The green shaded area represents the area, represents the gain required to break even. So a 10% loss requires about 11% gain to break even. A 50% loss requires about 100% gain to break even. So think about it. If you had $1 million portfolio and you lost 50% of it, you would be left with $500,000. You would need another $500,000 or another 50%, another 100% of what you have just to get back to break even. Anyone heavily invested in tech stocks back in the tech bubble, early 2000s, might have experienced a 75% decline in their portfolio. That would have required a 300% gain just to break even. So the point here is that the further you go down into that hole, the greater the losses, the more difficult it becomes to recover from those losses. So we want to remember to minimize our losses. As investors, you all know, 100, 200, 300% gains don't come along all that often. And so it's very difficult to recover from these types of losses. And the further, the greater the loss, the harder it is to create long-term wealth. The other concept that I shared with you back in October of 2019 was the concept of better risk-adjusted returns. And I like to use this chart to explain what I mean by better risk-adjusted returns. This chart has standard deviation on the x-axis. Standard deviation is just a measure of volatility. Lower volatility on the left side, higher volatility on the right side. And volatility typically implies risk. So we can look at this as lower risk and higher risk. On the y-axis, we have annualized returns. So what I've done is I've taken some of the major indices, the Russell, the S&P, the NASDAQ, also a Vanguard Total Bond Fund and a money market, and I've plotted the risk and return of each of those indices. And I've drawn this black line here. This is simply what they call a regression line. And it visually displays the trade-off between risk and return. The more risk we take, the more return we would expect, right? Over a long period of time. Now, not every investment is going to fall directly on that line. And so what I've done here is drawn two parallel dashed lines here. The area between these two dashed lines represents what I call the long-term expected return channel. So once again, that's what I consider the long-term expected return channel. This is the area where most investments, not all, but most investments are going to fall in between these two lines. Now, as investors, we have to take some risk, as I said before. If not, we would be subject to probably money market type returns. And over this long period of time, from 99 to 2022, money markets have provided a sub 2% return. Now, that hasn't always been the case, right? During certain periods of time, money markets have provided substantially higher returns, and in some parts of this time period, they've provided very lower returns. So we don't have any real control over the returns that we're going to receive, but we do have all the control over how much risk we take, right? We can decide to put our entire portfolio in the S&P. We could decide to put our entire portfolio in a money market. And in that manner, we can control how much risk we take. Most investors I speak to prefer to get up and outside of this long-term expected return channel. This is what I call better risk-adjusted returns, taking a small step out on this risk scale and trying to achieve as much return as we possibly can. And back in October of 2019, I shared with you my strategy, which is based on using moving average timing on low volatility asset classes. I use junk bonds as an example of how to do that. And I explained to you how we could achieve these types of results. So what I'd like to do, as I said before, is let's do an assessment to see how this worked. Give me 1 second here. Okay. So on this slide here, we have the S&P 500 in red. This goes back to January of 2007, along with a strategy, the RGB core strategy. This is a strategy that I run for myself, my mom, my clients, using the techniques that I described to you in 2019. As you can see here, the returns for the RGB core strategy were 8% compared to, say, the S&P 500, which were about 6%. And I'm very proud of that. Obviously higher returns are always better. But what I think is much more important is the volatility that we had to expose ourselves to achieve those types of returns. The volatility S&P 500 was just under 6% compared to under 1% for this green line, the RGB core strategy. So that volatility was 1/7 that of the stock market or the S&P 500. So as you can see, we had higher returns on lower volatility, and you can see how that might push us up into that upper left-hand quadrant of the risk-reward chart. So let's see how it did. So you can see here, here's the pandemic that we looked at earlier. The green line, you can see we took a little bit of a hit, but we were able to protect our capital using the strategies that I shared with you. We were able to participate in a lot of the upside of the market. And now that we've entered a bear market, you can see that we've trended sideways to down just slightly, but have for the most part, protected our capital. So my assessment is that the strategies that I shared with you last time are working. They worked effectively to protect our capital, provide reasonable returns, and at the end of the day, provided better risk-adjusted returns. So anyone following this strategy likely would have experienced similar type of portfolio results. So I know not all of you were at that session. So let's take some time to review. Even those of you who were at that session, it's probably a good opportunity to review those concepts. What I'll do then is we'll look specifically at how the strategy performed in kind of focus in on the pandemic time period, and we'll focus in on the current bear market environment. And then we'll talk about some of the implementation considerations that you'll want to consider if you decide to move forward with this. So let's start off. So as I said, the concept is based on using moving average timing on low volatility asset classes. There's a number of low volatility asset classes, but to me, the epitome of a low volatility asset class are junk bonds. Junk bonds are simply below investment grade bonds. And what you see here on the screen is an index. It's the US High Yield Master 2 Index. It's produced by B of A Merrill Lynch. And you can see, this chart goes back to the beginning of the century, that the index tends to move up and down with the stock market, right? This is the tech bubble time period. It declined a little bit. It rallied up high, fell down during the 2008 financial crisis, rallied up. This was that debt ceiling debate here. This was that stealth bear market that we talked about. Here's the pandemic, and here is the current 2022 bear market. So you can see, although they are bonds, they tend to have characteristics of equities, right? They're risk assets, and they move up and down along with the risk in the market. So it's important, I think, to take a moment to understand how junk bonds work and why they move in the same general direction as equities. So this is a chart from 2011. The red line's the junk bond index, and the green line is the 7 to 10 year Treasury bond ETF. You can see for the first half of the year, they were both trending up in the same direction. And then something happened in August of 2011 that created an environment where Treasuries rallied higher and junk bonds fell. Well, what happened was that debt ceiling debate. So what was happening at the time was our elected officials in Congress were debating whether or not to raise the debt ceiling. Without raising the debt ceiling, the US would not be able to meet all of their financial obligations, which obviously would create uncertainty for the stock market. And investors certainly don't like uncertainty. So investors fled to the safety of US Treasuries. That additional demand for Treasuries drove Treasury prices higher and yields lower, right? Yields and prices are inversely correlated. However, the exact opposite happened in the junk bond market. While junk bonds are certainly influenced by interest rates, they're also influenced by overall economic conditions and market risk. And at the time, junk bond investors were demanding higher yields to compensate them for this additional risk that was in the market. Those higher yields, right? We said that yields and prices are inversely correlated. So the higher yields on those junk bonds created prices to fall. And we see this pattern happen over and over again. Here's another example. This is in 2014. This was the start of that period that I referenced as the stealth bear market. This was a period of time where there was some concerns about global growth. Treasuries in green and junk bonds in red were trending up about the same pace for the first half of the year. And in the middle of the year, something happened that drove investors to Treasuries, and junk bonds sold off. Again, it was those concerns about global growth, higher risk. Investors fled to the safety of US Treasuries, and junk bonds sold off as junk bond investors demanded higher yields. Here's one more example. This is an example of what happened during the pandemic. This is a one-year chart from March 2019 to March of 2020. Junk bonds and Treasuries were trending up about the same pace. And then all of a sudden, something happened. Well, we all know what happened, right? The pandemic hit the shores of the US. Investors fled to the safety of US Treasuries, and junk bonds sold off pretty hard, pretty fast. So you can see that junk bonds have similar characteristics to bonds, but they also have similar characteristics to stocks. And if we were to take a look at a longer time frame, junk bonds here in red, the S&P 500 in green, you can see that they tend to trend in the same direction, right? Junk bonds didn't trend down quite as hard during the tech bubble, and that's primarily because there wasn't a lot of junk bond exposure to tech companies at that time. They both rallied following the end of that bear market. During the financial crisis, they both sold off, right? You could see the strong sell-off here in junk bonds, the strong sell-off in the stock market. And then they both rallied. We see the decline during that stealth bear market period. You can see that Fed fumble period, junk bonds sold off, as well as the stock market. You could see here the pandemic, they both sold off pretty hard and rallied together, and now they're selling off again. It's this quality of junk bonds to follow that of the stock market that makes them an attractive investment for investors. And if we were to just look at junk bonds compared to the stock market over this time period, junk bonds provided a 6% return compared to about a 4.25% return for the stock market, for the S&P 500. But what's interesting is that junk bonds provided those returns on a fraction of the volatility. This is the volatility of the junk bond market is about 1/4 that of the stock market. So you can see here how we're starting to piece together, right? Higher returns, lower volatility. You can see how this might start fitting into our risk reward chart, right? Just a buy and hold of the junk bond market, which I'm not encouraging by any means. I'm not a buy and hold investor. But even if I were, let's assume I was a buy and hold investor, I would much rather buy and hold a pool of junk bonds than equities. Why is that? Well, I'm getting, let's say, equivalent or maybe slightly better returns on a fraction of the volatility, on 1/4 the volatility of the stock market. You can see by plotting the results of the high yield master 2 index, we're starting to get outside of that long-term expected return channel and up into this upper left-hand quadrant of this chart. And this is where most investors that I speak to want to be. They want to take a little risk, but they want to try to achieve as much return as they possibly can. And just by moving from, say, an equity portfolio to a portfolio of junk bonds, starts to help you move in that direction. So it's very consistent with investors' desire to minimize risk and maximize return. But we can do better. And that's what I shared with you back in October of 2019. So the concept is based on using a moving average of the junk bonds. And when junk bonds are trending above their moving average, we want to hold them. When they're trending down below their moving average, we want to sell and move to cash. So on this chart, what you're looking at is the red line is the junk bond index. The purple line is the 50-day moving average. And you can see here, junk bonds during this time period were trending up above their 50-day moving average. They peaked at this point A. They crossed below the 50-day moving average at point B. Ultimately, they bottomed here at point C and crossed back above the moving average at point D. Now, the distance between point A and point B is very predictable. This is what I call timed drawdown. Over the history of the junk bond index, the distance from point A to point B, the time it peaked to the time it crosses over its moving average, is typically in the 1% to 3% range. For most investors, this is an acceptable drawdown for having exposure to the market. The total drawdown, point A to point C, is not predictable. We never know in advance how far the market's going to decline before it bottoms and goes back up. But what this type of strategy does is it will always protect our capital so long as we heed the signals that it's providing. So let's take a look at what this might look like if we were to take those trades as I suggested. So again, this top panel here is simply the chart that we looked at on the last slide. This bottom panel here is the results of moving into and out of junk bonds based on its position against its 50-day moving average. So this bottom panel actually has two lines on it. There's a red line, solid red line, and there's a composite line, which is the red and green line. That composite line shows the results of moving into and out of junk bonds based on that 50-day moving average. So you can see it was trending above its 50-day moving average. We were owning it. It fell below, moved to a money market. And when it crossed back above, we re-entered the market, and you can see that's represented by this red line. Now, having taken these two trades during this time period would have taken your annualized return for this 1 year period, the 1 year return, from just under 3% to about 9%. Of course, that is a direct result of missing the large decline here, which was an 8.7% drop from point A to point C. Not only did we achieve higher returns by making those two trades, we also reduced volatility. Volatility went from 1% down to 0.5%. So again, you can see here, the concept here is about reducing volatility and increasing returns. And by taking these two trades during this 1 year time period, you would have done exactly that. So here's another example. This is an example during the great financial crisis. Point A, the index peaked, crossed below the moving average at point B, remained in cash until all the way down here, it bottomed at point C. Cross back above, we have what this is called a whipsaw, right? We had a false signal. In retrospect, we probably preferred not to have taken that signal, but we never know what's going to happen in the future. So if you took that signal, you would have been in for a short while, gotten back out. But then when the market bottomed in March of 2009, the junk bond index crossed back above its 50-day moving average, and we had a really, really nice run. You can see here the returns for just buying and holding over this 2 year time period. The annualized return was 7.6%. If you had taken those trades, the return went to 28.5% annualized over that 2 year time period. I don't have the volatility metrics on this slide for some reason. I apologize for that, but I can guarantee you the volatility of this composite line is substantially less than that of the junk bond index itself. So once again, we've created higher returns on lower volatility. And one of the things I want to highlight here is this little whipsaw area. There is no perfect strategy, right? There's no strategy that will get it right 100% of the time. And this is an example of how this strategy didn't get this particular bottom quite correct. It took a little bit of bottoming before we were able to reestablish a solid uptrend. But once again, by taking those signals and being consistent with those signals, we were able to benefit that. And that's certainly reflected here in the returns. So if I was to compile the index against its moving average all the way back to the beginning of the century, this is what it would look like. Again, the top panel is simply the junk bond index. The bottom panel is the junk bond index in red, and the composite line, which is the red and green line, reflects the trades that were made into and out of the index based on that 50-day moving average. The returns if you just bought and held during this time period, were 6.6%. And the returns by making those trades moved up to 10.2% annually. So that's pretty significant, 4% increase on an annualized basis. Again, that's certainly something we want to strive for, but what is more important, in my opinion, is that we were able to reduce volatility. Standard deviation went from 1.5 down to about 0.8. Lower volatility and higher returns. That's sort of the theme of this strategy and the theme of how we can protect our capital going forward. So if we were to plot this time strategy on this risk reward chart that we've been looking at, we move further up and to the left of this risk reward chart, right? So this technique, this moving average timing technique, is very consistent with most investors' desire to strive for, lower risk, taking a small step out on this risk scale and trying to achieve as much return as we possibly can. So that's what I shared with all of you last time. So hopefully that was a good refresher. If this is your first time, hopefully that makes good sense. I'm happy to take questions at the end, but that is the basis of the strategy, and it works really well during times of crisis. So one other way to look at that, this is just looking at the same data in a slightly different fashion. This chart here shows the S&P 500 in red. It shows the junk bond index in green, and it shows the results of timing the junk bond index with a 50-day moving average, trading in and out of the index along with the money market. So just visually, you can see the benefit of moving from, saying, an equity portfolio to, saying, a buy and hold of the junk bond index. And you can also visually see the benefits of moving from that green line to the yellow line, right? Visually, you can see that yellow line has substantially less volatility, downside volatility, than the red line and the green line. And it's produced significantly higher returns. So the S&P over this time period produced about a 4.2% return annually versus 6% for the index and 10% for the time strategy. And you can also see the standard deviation continues to decline as we increase our returns. So I've also put down here, I love charts. I love looking at charts. Just visually, they tell us a lot. It's also good to also review the quantitative metrics. So that's what I've put down here in the bottom. Here are the three lines, those annualized returns, maximum drawdown, and standard deviation. The ULSR index and the UPI, I don't have time to get into details with those today, just given our limited time, but ULSR index just is a measure of downside volatility, very similar to standard deviation, but just focuses on that downside volatility, where standard deviation focuses on both upside and downside. Best thing that you need to know today is that the higher the ULSR index, the more volatile that particular investment or index is. UPI stands for ULSR Performance Index. It's a measure of risk-adjusted return, very similar to the Sharpe ratio, if you're familiar with that. The higher the UPI value, the better the risk-adjusted return. And so what I've done is I've highlighted the values in red that were the worst performers, and I've highlighted the values in green that were the best performers. And you can see that moving from the S&P 500 up to a timed junk bond strategy really improves the metrics of your portfolio and what you might expect. And most important, I think, is, and this is something we can all relate to, is drawdown, right? We all feel drawdown, right? We open up our portfolio statements, and if we had $500,000 and now we have $450,000, that has a direct impact on us. So comparing the drawdown of the time strategy to the S&P and the junk bond index, you can see it's 6%, just under 6%, is significantly less than the drawdowns in those other two indices. So let's take a few minutes now and drill into the pandemic time period to see how the strategy works. So basically what I'm doing now is just I'm zooming in on this 1 year time period from 2000, basically the year of 2020. And wanted to show you how, even though the pandemic was one of the fastest sell-offs that I've experienced in my career, the S&P sold off, I think 34% in a matter of 23 trading days. That was a very fast-paced decline in the stock market. You can see that junk bonds had a similar decline. This was a 21% decline in the junk bond index. But you can see, though, using a 50-day moving average, we were able to limit that drawdown. I think this was somewhere in the 2% range, and move to cash and protect our capital during a very uncertain time in the market. This is something no one was expecting. This is something that no one had really dealt with before, and we didn't know what was going to happen in the future. And so it was very comforting knowing that my clients were in cash, knowing that my own portfolios were in cash during this time period. So I think it did a really good job of protecting capital, as it always does. Typically, the junk bond index does a good job of getting us back into the market relatively early. Going back to the 2008 financial crisis, the bottom of that market was March 9th of 2009. The index, this strategy had us back in the market by, I think it was the third week of March. So generally it does a pretty good job of getting us back into the market. In 2020, it didn't do such a good job, in my opinion. It did a great job of protecting our capital, and that's obviously a top priority. So it did a fantastic job there. It did not do a good job of getting us back into the market early. You can see it was really not until sort of middle of May before we really got into the market. And by that time, a lot of the big returns had passed. Now, anyone who subscribes to my newsletter, I publish a weekly sort of note and a monthly newsletter. I'd offered this to everyone at the Silicon Valley chapter last time I was here. For those of you who were participating and receiving that free newsletter, and I'll make an offer to everyone again, you're welcome to receive those. At that time, I had put in that newsletter, the monthly newsletter, this was on April 9th, 2020. I said the steep declines in the bond and income groups have created a unique opportunity for investors to benefit from the potential rebound in these groups. While most have not crossed above their 50-day moving averages, all but the most conservative investors might consider stepping back into the market. So what I was suggesting, so here's April here, what I was suggesting was that we get back into the market at this point, and that provided us a nice run up and an earlier entry. Now, the reason I did that was the steps that the Fed and the US government were taking to flood the market with liquidity was unprecedented. And it was going to have a substantial impact on the market, which obviously it did, as we've seen in the charts before. So I took the unusual step of breaking the strategy and not waiting for that 50-day moving average, but getting in early. The Fed was buying bonds, mortgage-backed securities. They were even buying junk bond ETFs, which was simply unheard of. So they pulled out all stops, and if we had waited, we certainly would have missed out on some upside opportunity there. But again, if you're participating in that newsletter, hopefully that helped you back during that time frame. If you want to receive that newsletter, I'll let you know how you can do that at the end of the session here. So let's move on to the current market environment. So here we are. This is the 2022 time frame. This is a 1-year chart, October to October. This is the junk bond index in red, and you can see that it was bouncing around its 50-day moving average at the end of last year, peaked at the end of December, and declined in January, and has remained below its 50-day moving average for most of this time, with the exception of this little whipsaw counter trend rally that we saw here. I'll talk about that in a minute. But using the moving average timing, once again, protected our capital. We were able to, whether you were out here in the November, December timeframe, or even in January, you protected the majority of your capital and have been sitting in cash. In this market environment, the saying goes, cash is king. Cash is a valid asset class during certain times. And by protecting our capital, we don't have to sustain those large losses that are so detrimental to creating wealth. The maximum decline in this index right now, which is this peak here to this trough here, is just under 15%. And that represents the third largest decline in the index, in the history of the index, only to be surpassed by the great financial crisis and the decline during the pandemic. So what does that mean? It means there is a fantastic opportunity, maybe one of those once in a lifetime opportunities, I believe, is ahead of us. Whenever we get through this bear market, and we'll get through this bear market at some point, there is going to be just a fantastic opportunity to participate in this rally. When the Fed goes from their more aggressive monetary policies and becomes more accommodative in the future, we will see a bounce in the junk bond index. We will see it jump back above its 50-day moving average, and we'll get some of those returns like we saw following the great financial crisis and the pandemic, which were both fantastic years. Comment on this little counter trend rally. We had what looked like to be a good uptrend forming in the junk bond index, as well as stocks and other risk assets. Trended up above its 50-day moving average. If you took that signal, you would have jumped in, participated, and given back all those gains. But once again, by having that stop, using that 50-day moving average, you prevented any further decay in your portfolio. This was not a profitable trade, but we need to be consistent with our trades, because we never know if this trend up above its 50-day moving average is going to be the start of a new long-term bull market or not. So being consistent with your trades is super important. We don't know if the next breakout above the 50-day moving average is going to be the bottom of the market. But again, we want to be consistent with our trades and protect our capital. But what I can say, as I said before, is that there's a fantastic opportunity that is being developed. And in fact, the further this junk bond index goes down, the better that opportunity is going to be. So make sure you're protecting your capital and waiting for that better opportunity that's going to be presented to us in the future. So that's the concept. What I'd like to do now is move into some implementation considerations. Don't know how we're doing on time. I don't have a lot of time. So what I did was, I usually have slides that support a lot of these implementation considerations, but what I wanted to do, and I thought would be best for this group, is to go through this list of frequently asked questions. And then if I have time, I'll share some of the slides with you that support this data, but I'd rather get through the data and the information so at least you have some exposure to it. And then if we have time, I can show you some of the more detailed slides. So first of all, where can I access this B of A Merrill Lynch High Yield Master 2 Index? There's two places that I'm aware of that provide this data. One is a tool called Investors Fast Track, charting and analysis tool. They've got a tool called FT Cloud. It does require a subscription. This is the tool that I use. All the charts that you've seen today have been produced by Fast Track. I have no affiliation with Fast Track. If you decide to sign up, that's fantastic. But I certainly don't benefit from your subscription there. I use Fast Track because it's one of the best tools, in my opinion, available. It has the cleanest dividend adjusted data in the marketplace, and has unique capabilities to rank and sort different investment options based on different risk and return criteria. So certainly works for me. It works for this type of investment approach. The other place you can get the High Yield Master 2 Index data is from the St. Louis Federal Reserve Economic Data website. FRED is its acronym. The data there is free. However, you cannot plot a 50-day moving average. You cannot plot a moving average period on their website. You would have to download that data, which they allow you to do, bring it into Excel possibly, and create your own charts from there. But those are two options if you're looking to track that data. A third one, I guess, which I didn't put on here, is in that monthly newsletter I produce, I certainly share a chart of the junk bond index. That's another free way to get access to that website. You just wouldn't have access to it on a daily basis, and you wouldn't be able to manipulate it or chart it in any way. But that's a third way if you want to sign up for that newsletter as well. Next question is, I can't invest in an index. How do I get exposure to the junk bond market? Well, as we all know, we can't invest directly in indices, but junk bond mutual funds generally do a good job of tracking the junk bond market. Junk bond mutual funds, I should say, have a strong correlation to the B of A Master 2 Index. And so what that means is they tend to trend in the same direction, that they're not 100% correlated. One of the things that the junk bond mutual funds have are expenses that the index doesn't. So there's certainly some decay on the mutual fund side compared to the index, but that is something that you would expect. And I always get the question about, can I use junk bond ETFs? I'd much rather trade ETFs, Rob. Why can't I use ETFs? Well, you certainly can use ETFs, but I think you're not going to get the risk-adjusted returns that you might expect. The volatility of junk bond ETFs is significantly greater than that of the junk bond mutual funds. And the strategy is directly dependent on the volatility of the investment that we're using. And that increase in volatility of those ETFs makes the moving average timing less effective. And if I have time, I'm going to show you a chart and kind of explain why that's the case. So hopefully I'll have time to do that for you guys. Let's see, next slide. Why do you use a 50-day moving average? Well, there's no magic to a 50-day moving average. 50-day moving average, in my opinion, provides a good balance between downside volatility, positive returns, and a reasonable number of round trips. You can certainly adjust your moving averages based on your own preferences. Junk bond mutual funds don't like us to trade too frequently, although we certainly can trade them, into and out of them. So if you get less than a 50-day moving average, or if you use a 50-day moving average, something less than a 50-day moving average, the number of round trips increases. And so your trading increases, which is more work for you. Certainly you have to be more cautious of the frequent trading rules of the mutual funds themselves. So I use a 50-day moving average as just a kind of a sweet spot, between protecting our capital, generating reasonable returns, and limiting the number of round trips. There's a slide here that you can reference later that I share with you the results of using different moving averages. What about taxes? You know, moving into and out of the market is going to create a taxable event. That's certainly the case. And taxes in our non-qualified or our taxable accounts are certainly important, but in my opinion, certainly less important than protecting our capital. Go back to our rule number 1, don't lose a lot of money. If you are someone who's concerned about taxes, you're most likely a long-term buy and hold investor. This strategy probably doesn't make a lot of sense for you, but it might make sense in a qualified account, an IRA or Roth IRA account. You could certainly make use of it there. But my suggestion is that you focus on risk-adjusted returns that are appropriate for your personal financial situations. Outside of long-term buy and hold investors, all trading strategies are going to incur taxes. It's just part of the game. Focus on generating those better risk-adjusted returns. People often want me to suggest what mutual fund that they should use, and that's really difficult for me to do. I'd love to do so. However, the mutual fund that you choose is going to depend on your tolerance for risk and recent fund performance, right? So if you had a junk bond mutual fund that sold off very hard during a certain market decline, it's more likely to have a higher rebound. That may not be appropriate for a more conservative investor. I suggest using a charting tool such as Fast Track to evaluate the different mutual funds prior to purchasing them. Now, having said that, most of the major fund families, Vanguard, PIMCO, BlackRock, Lord Abbett, Mainstay, they all have junk bond mutual funds. This is an asset class that most fund families, at least if they have any income funds, will have a junk bond mutual fund. So check your trading platform, find out what funds are available on your platform. You know, definitely I would suggest take a look at a chart before you invest in anything. Make sure it's something that you would want to own. But you can start with all the major fund families, and they all have junk bond mutual funds. Where can I learn more about Fast Track? Fast Track, as I said, is the tool that I use. Their website is on the screen there, investorsfasttrack.com. You can sign up for their, they've got, I think, a 2-week free trial if you're interested. I would suggest using the FT Cloud product. They have an old legacy product called FT for Web. I would use the FT Cloud product. There are also resources available at the San Diego chapter of AAII's website. I talk a lot about this in one of our special interest groups called the Risk Management Special Interest Group. If you go to our AAIISanDiego.com website, look under the subgroup page for risk management. We have all of our past SIG meetings recorded along with training materials. I conducted a 4-day training session, which is all recorded and available there to all of you. So feel free to take advantage of those resources. And then if you're interested in receiving a Fast Track tip of the week, one of our San Diego members, Jim Hoffman, produces a tip of the week. It's just a kind of a 2-3 page little note that shares something about Fast Track. It's just a good little note to receive and may enhance your learning of the Fast Track tool set. So feel free to email him directly at James T. Hoffman, 2 N's there, at yahoo.com, and he will put you on the distribution list. And lastly, can I use moving average timing techniques to for entry and exit into stocks? Well, as I said before, the strategy, the moving average timing strategy, works because of the low volatility nature of the junk bond mutual fund or other low volatility asset classes. Stocks are just too volatile. It really limits the effectiveness of using moving average timing. It will not work. Some people have suggested using moving average timing signals on the junk bond index itself to then time their purchases in the stock market. I've tested that out. It just doesn't work. Moving average timing works best on these low volatility asset classes, such as junk bonds. There's other asset classes as well that I outline in my monthly newsletter. And you can take a look at that if you are interested. So I've got 11:20. I think, I'm not sure what time we were supposed to wrap up here. What I want to do is take the next couple minutes and talk about why junk bond ETFs just don't work. And I've got a couple slides here since we have time to go through them. This slide here is the Merrill Lynch Master 2 Index in red, and the green line is an index that I produce. It's a junk bond index. It's available in the Fast Track tool set if you subscribe to it. But it's a composite of 10 large junk bond mutual funds. So it really represents the junk bond mutual fund marketplace as opposed to the junk bond index itself. So the green line actually has all those expenses that I was referring to. And you can see that over time, while these two lines are very highly correlated, right? The correlation here is about 97%. There is some decay in the junk bond, the green line, which is a representation of those 10 mutual funds. And that's directly related to the fact that they have expenses associated with running those mutual funds. But overall, you can see they trend in the same direction. Now, what I've done here is I've added a yellow line. So the red and the green line are the same two lines. I've added a yellow line, which is HYG. This is the iShares Junk Bond ETF. And you can see, while the returns of the index and the mutual funds are, index was a little over 6% for this time period. The mutual funds was a little under 6% for this time period. The ETF was less than 5%. So you can already see that we're not getting the returns that we might expect. But in addition to that, and more importantly, is that the volatility, while the volatility of the index and the mutual funds are pretty similar, in fact, the mutual funds are a little bit less. That probably is attributed to the fund managers picking and expertise in picking individual junk bonds. The ETF is significantly higher. It's almost 2 to 3 times higher than either the index or the mutual funds. And it's that increase in volatility that limits the effectiveness of this moving average timing. So if I was to time the index, we see the results in red. The timed results of the mutual funds is shown in green, and the timed results of the ETF are shown in yellow. You can see that the index and the mutual funds both produced roughly a 10% annualized return. The index itself the ETF produced about a 5.3% return. And the volatility, very similar for the index and the mutual funds, and significantly higher for the ETF itself. So as you can see, this shows that the use of ETFs in this particular strategy, I love ETFs. ETFs are fantastic if you're trading equities, but for the bond and income side of the world, they just don't do as good a job of managing overall risk and volatility. And you can see the degradation in our results. We're not going to get those better risk-adjusted returns that we're hoping for when we use an ETF. So I wanted to share that with you. I'm going to go through some of these slides. I talked about those. Just to kind of summarize, as I mentioned earlier, we as individual investors can control risk, but we cannot control our returns. The market provides returns, but we can certainly control how much risk we expose ourselves to in the marketplace. Continue to focus on those downside risk metrics that are important to you. MAC drawdown is a good one to focus on. Minimize those declines in your portfolio. Market corrections are going to happen in the future. I'm sure we haven't seen the last of the volatility of this current bear market. There will be a bull market that follows this. Make sure you have the majority of your capital to take advantage of it. And try not to overcomplicate this strategy. Keep it simple. Invest in the junk bonds or other low volatility asset classes when they're moving up above their moving average. Sell them when they're trending down below their moving average. And if you ever find that you're in a trading range environment, wait for a trend to develop before you make your next move. If the trend bounces up and you're already invested, stay invested. If you're invested and the trend falls below the bottom of that trading range, that would be a good time to sell. Whipsaws are a normal aspect of investing, as I showed you a couple times. One happened this year when I showed you one in 2008. Stick with the plan, and you will be rewarded. And certainly check the frequent trading restrictions of any mutual funds that you buy. You always want to check the prospectus, make sure you understand the fees, any early redemption fees that might be associated with those types of funds. And always, regardless if you're using this strategy or any other strategy, you always want to avoid those life-altering losses. So make sure you have some stops set, whether they be mental or systematic stops, so that you can avoid those life-altering losses. Now, I mentioned those two publications that I produce. These are both free. I offer these to your chapter members. One is my weekly note. This is a note that I share with my clients. I'm happy to share with all of you. It simply provides my perspective on what's happening in the market. Usually there's a few charts, a few comments about what's happening in the market and what I'm doing to adjust to changes in the market. I often talk about the junk bond index in here, so it's another way for you to get exposure to that information. There's the market monitor that I've referred to several times. If you'd like to sign up, there's this URL. I'm going to put the URL in the chat. Tell me whether or not you want to receive them. If you don't want to receive them, don't click on the link. If you're also interested in any of our services and how we help manage our client money, there's an opportunity for you to request a meeting as well. But with that, I will turn it back to you for any questions.
All right, thank you, Rob. The first question we have is, will this system still work while the Fed is raising interest rates?
Absolutely. The Fed is certainly in a tightening mode. They're raising rates. It's certainly driving down the prices of all risk assets, stocks, junk bonds, and other economically sensitive bonds. And it has us in cash. And so it's doing exactly what it's supposed to be doing. There will be a point where the Fed changes its stance. And if you look at their dot plot has rates peaking next year in 2023. So I wouldn't be surprised if the Fed starts to at least give some indications that they're going to stop raising rates. Not this year, I don't think. I think you're going to continue to see rates go up right now. I think they're the low threes, 3.25%, up to probably about 4% by the end of this year. Maybe another hike or two, but I think they're going to start to give some indication that they'll start pulling back. If you look at the dot plot, the longer term Fed funds rate is certainly going to start dropping in 2023, 2024. So yeah, I think this strategy works well. And it's worked well not only for the current market environment, but for shocks that we just didn't anticipate, like the pandemic that we saw. As you can see, it worked pretty well during that time period as well.
Great, thank you. The second one, I'm going to combine two questions. How do you address diversification when using this strategy? And what parts of kind of a total portfolio asset allocation is this strategy applied to? Can you address kind of, the general thing around allocations?
Sure. I guess a lot of it depends on who you are as an individual, and your tolerance for risk. As you can see, this type of strategy is going to put you in that upper left-hand quadrant of that risk-reward chart. If that is how you are wired as a individual, putting 100% of your portfolio in that type of strategy could make a lot of sense. For example, my mom, we have majority of her capital in this type of strategy. It allows her to sleep at night. She is not concerned about waking up and finding the stock market down, 3, 4, 5% in a day, because we know that the strategy is not going to be subjected to those types of market swings. I have a majority of my capital in this type of strategy. This is just the way I'm wired. I have other clients that use this strategy. They follow the Christine Benz bucket method. I assume most of you are somewhat familiar with that. They use this strategy as part of their bucket 2. They know it's going to maintain the majority of its capital, it's going to earn a fair return, and then they keep some of their longer term assets in their bucket 3 and more riskier stocks and things like that. So at the end of the day, there's no magic answer, there's no right or wrong answer. If you are concerned about your entire portfolio and you're in the later stages of retirement and you want to protect your capital, this type of strategy can be very appropriate for that. If you have certain portions of your portfolio that you're trying to protect but still earn a fair return, there's certainly a good argument could be made for putting a portion of that into this strategy as well.
That's very helpful, thank you. Can you discuss any costs or fees that are associated with this approach?
Sure. The costs of implementing this approach as an individual investor is really dependent upon your brokerage platform and what they may charge for trading. There are many funds out there that are available for no transaction fee on the trading platform that I use. But that's really going to be dependent on the trading platform, whether you're using Schwab or Fidelity, and what they charge. Some of those firms have short-term redemption fees, what I call broker-imposed short-term redemption fees. You'll certainly want to stay away from those. What that means is, I know TD, when it was as a standalone entity, if you didn't hold it for, I forget if it was 90 days or 180 days, they charge you a fee on an NTF, or a no transaction fee fund. So just be aware of those funds. And there are platforms available that you can get access to a lot of these mutual funds without these expenses, these trading fees, but that's going to be the big expense for sure. And as I talked about before, there's certainly the tax impact on a taxable account, but again, the focus should be generating better risk-adjusted returns.
Great. And I think our final question is, when you talk about cash, what investment vehicles are we talking about here?
Yeah, good question. So when I move to cash, I'm typically moving to a money market. Money markets, over the last many years has not paid much, but the goal of moving to a money market is certainly not to earn a big return, it's to protect our capital. Money markets are, now that the Fed is raising rates, money markets are certainly paying a little bit more. But I'm just looking for money market mutual funds. I want the flexibility to be able to get out. You certainly could look at other vehicles, but you want to make sure you don't lock up your capital, like into a CD, for example. That may lock up your capital and you may miss out on the next opportunity. Usually the best returns during the next opportunity happen at the onset. And so you want to be able to take advantage of that. And if your money's locked up in some short-term CD, for example, you may not be able to participate in all of the upside that's available. So I would suggest using a money market, something that you can get into and out of relatively quickly.
Well, excellent. I think that's all of our questions for today. Thank you so much, Rob, for joining us this morning. And we hope to see you at a future event.
Well, thanks for having me. I appreciate that, and look forward to chatting with you in the future. And as I said, please email me. If anyone has questions that come up after this call, I'm glad to be a resource for all of you guys. Feel free to email me with questions, and I'm happy to respond to those. I do it all the time.